To help dig Europe out of the economic crisis, 11 EU nations are set to introduce a controversial new tax on financial transactions. This Robin Hood tax has been approved by Parliament and would apply to the movement of shares, bonds and derivatives. Supporters say it targets those partly responsible for the crisis, the traders, and would discourage risky transactions and calm the markets. But opponents fear that it will burden banks and raise very little revenue. To get two views on this divisive issue, EuroparlTV spoke to Anni Podimata, a socialist and Democrat member who is Vice President of the European Parliament, and Martin Callanan, who's chair of the European Conservatives and Reformists group. How will this tax help Europe out of the economic crisis?
Well, I don't believe that a FTT is going to help Europe out of a financial crisis, because I think the reality is, with only 11 countries effectively in the world adopting this tax, it's very easily avoided, it's very easily got round, and I think it will end up raising very few revenues. At the end of the day, it's a political gesture, nothing more.
Well, it's about social justice in Europe. We're still in the midst of the crisis, and the normal European taxpayers, the normal European citizens have assumed the burden of this crisis. That it was due to their contributions that we have been able to avoid the financial sector collapse.
Is now the right time to introduce a tax that could be a burden on banks?
I think an FTT would be an additional burden on the financial sector, and it's not just the banks that would pay it, it's the whole of the financial sector. It'll raise very little revenue, very bureaucratic, and of course the thing about international finance is that it's highly mobile. A lot of the trading is done electronically, and they can do it anywhere in the world. So I suspect all that they will do is end up forcing financial services companies out of their countries.
The question is not to create a further burden for the banks or for the financial sector in general. The question is to create an incentive in order to discourage the most harmful transactions that, in addition, they create systemic risk, and encourage the long-term investments so desperately needed for the recovery of the European economy.
Won't elderly people be hit through their investment in pension funds?
Well, of course, the people that will end up paying for this financial transaction tax are consumers, whether they're elderly or anybody that buys a financial product will end up paying it. This idea that there's sort of free money available, propagated by the left in their support for this ridiculous idea, is just a nonsense, of course. It would be paid by consumers and by people that buy financial products.
Pension funds, since they have to manage pensioners' money, have to be very cautious, I think, and they have to make a choice of long-term investments that are more secure for their pensioners.
How will it really calm the markets and discourage risky transactions?
It's not going to make any difference to the risky financial transactions or speculation, because that will happen in offshore centres anyway. None of these taxes just will not work if they're not introduced on a global basis. And if it was introduced on a global basis, then I might have more time for it. But otherwise, it's pointless.
Well, nobody pretends that the financial transaction tax alone can stabilize the financial markets, that's for sure. But I think that the financial transaction tax, together with a stronger and more effective regulation and supervision in the financial sector, can significantly contribute to a more stable financial sector at the service of the real economy. I think that is our main task today.